Nobody wants you to know this. Many people are going to disagree with me. It's an inconvenient truth about property investing. Property investors, you should consider selling your property investments at particular points in time. Now, this goes completely against the grain of conventional wisdom. Your mum and dad's not going to tell you this. Your aunt and uncles aren't going to tell you this. Your swim instructor's not going to tell you this. Your barista isn't. Wherever you go, most people say, hold onto your property investments for dear life. Hold onto them until you die. And even then, don't sell. Pass them on to your kids and let them hold onto it for the rest of their life. That's the Australian way. It's the Australian mindset. It's why there's so few property transactions in Australia. But I'm going to present to you a situation where that actually goes against your interests and how it can hurt you in the long run. Now, there's absolutely no doubt anyone who's followed the simple strategy of buy a property investment, hold onto it, and hold onto it forever has done really, really well. But can you actually do better by selling and accessing better opportunities? That's what we're going to uncover in this video. And I'm going to share with you 3 reasons why I believe property investing is actually about selling sometimes, and how I've used selling to help level up my own portfolio and grow faster as a result. I've sold nearly a dozen times now, and each time it's helped me make a better decision and level up my portfolio to a whole new level that I didn't think I'd be able to achieve. And being flexible and adjustable to different market conditions and different opportunities is the key reason why. And it's also why I've been able to make step moves up on my own property investing journey. And I think you can too. You just have to be open-minded to selling your property investments at particular points in time. I'm also going to present some cool data to you, ABS research data that shows if you made a $1 million property investment 2 decades ago between 2 capital cities, I'm going to show you that your return is actually going to be quite similar. But if you sold and rebought at one particular point in time, so just one property choice in that 2-decade period, you could make more than double your return just by simply making one choice over that time period. It's going to highlight to you that property investing sometimes requires you to change gears, shift a little bit, and move into a different direction when the time is right, and it can yield better results over the long term. It's particularly important for Sydney property investors right now. I know many of you are talking about your cash flows, talking about the negative cash flow your property investment holds. This is something to think about when making a decision about those investments as to whether it makes sense to hold on to or sell and realize other opportunities. Hi, I'm Rulebook Syed. I'm one of Australia's top mortgage brokers for the past 5 years. I run Confidence Finance, avid property investor, have built a $25 million property portfolio inside a decade of property investing, ex-treasury economist, and I absolutely love property investing. My passion actually stems from a position of us losing our family home growing up and a position of financial weakness, actually. And what it did was drive a passion, purpose, and inspiration within me to go and deliver better financial outcomes for myself, my family, and hopefully pass on some of the education and wisdom from working with thousands of clients and property investors all across the country over to you. If you like this video, if you like the content here, hit that subscribe button and I'll keep producing more awesome content for you. Let's start by going through the 20-year performance between Sydney and Perth. I'm going to present a little chart to you here. What you see here in this chart of Sydney and Perth, there's a couple things to notice here. First is property. You'll see Sydney and Perth have generally, been rising over a period of time. Perth has had a very flat period, slightly negative period, but over time, over long run histories, property prices do rise. That's, a well-known fact about property investing, and that is the number one reason why all those people I mentioned at the beginning, your mum and dad, your uncle, everyone who talks about property, that's why they say hold on to your property investments with dear life, because they rise over time. That is true. That doesn't mean you have to hold on to that particular asset you've purchased, which is what I'm adding to the equation. Sometimes it makes sense to swap between assets. That requires you to sell. So that's one thing that I see when I look at a chart of Sydney to Perth. But I also see what return profile would $1 million invested in 2003 generate me in both capital cities. What do you think? Would Sydney have done better than Perth? Would Perth have done better than Sydney? Now, I've ran the numbers using ABS data, and what you find is the actual capital growth rates between the two cities over that time period is very, very similar. In fact, it's near identical. Sydney performs a little bit better, but once you factor in the slightly lower yield in Sydney versus Perth, you'll probably find that Perth actually made a better property investment over a 2-decade period than Sydney. That's one myth exploded. I think most people would have got that little Q&A wrong. Now, if you made that investment decision over 20 years, your $1 million invested would be worth around $2.7 million in either capital, whichever one you invest. So you would have made $1.7 million over 20 years. Pretty good. You more than doubled your money. You've done pretty well over that time period. You'd probably be pretty happy with that result. But if you look at this chart, you'll see that Perth actually outperformed Sydney for a cycle period between 2003 and 2009. Completely outperformed Sydney actually, completely smashed it. Sydney barely moved at all, while Perth, had doubled. So in exact terms, Sydney house prices in that 6-year period had only gone up 3% in total, while Perth had gone up, 103%. So what this shows is between 2003 and 2009. So if you break up that 20-year decision into 2 time periods, 2003 to 2009, if you had your money in Perth, that $1 million invested in Perth, you would have doubled your money. Then from there, this chart also shows that Sydney from 2009 has done pretty well. It looks like it's, shot up multiple times, had a couple down periods, but shot up multiple times. Meanwhile, Perth has pretty much gone nowhere. House prices are still pretty similar to their 2009 levels, albeit a little bit higher, particularly off recent times, and Perth performing fairly well post-COVID. Most capitals performing well post-COVID. But between 2009 all the way to 2020, over a decade-long period, Perth barely moved at all. In fact, may have moved backwards a little bit. If you made one decision over that 20-year time period, buy Perth in 2003, sell Perth in 2009, buy Sydney in 2009, if you just tweaked that investment strategy from just buy for that whole entire 20-year period and included that little checkpoint marker, you would have actually made $5.2 million. And this includes transaction costs factoring into it instead of 2.7. So your $1 million could either be worth $2.7 million in 20 years' time, or it could be worth $5.2 million. Obviously, making $5.2 million is so much better. You've made an extra $2.5 million. Instead of making $1.7 million in a net return, you're making over $4 million. So one simple decision shows that you could do much, much better by simply selling and buying at a particular point in time. Obviously, choosing the exact point in time is a hindsight call. It's tricky to do. What the point of this data is, it's to show you that capitals and Sydney house prices and, national house prices all move at different rates, and that offers you opportunity. To access those opportunities and differences in capital growth rates over time, you will need to sell and reallocate your capital. So that's the number one reason to sell. Markets move at different rates, and this is a classic example of how you can see that over a period of time, that just one buy-sell decision can generate a much higher return for you by simply selling and buying at the right times. And it's just to get you thinking about the number one reason to sell. Don't think everyone is aware that different capitals grow at different rates. So that's the number one reason to sell. Number two reason to sell is your borrowing capacity is extremely scarce. It's now tied very closely to your income. And unless your income is going to continue to shoot up, and rise substantially year on year, you'll find that access to opportunities is limited and you will not be able to continue to buy over time. That's because once you've made your property investing decision and you've purchased, you will not be able to simply buy another property investment in a different area at some point. You'll hit your serviceability wall, and that limits you from purchasing other opportunities. The second big reason to sell is to re-access your borrowing capacity. And that ties into number 3. It's about opportunity. Selling to purchase for the sake of selling and putting your money into cash, not so good. That's not going to generate you a better return over time. If I charted that out, it wouldn't be pretty. But selling to buy in a different opportunity and being flexible to different opportunities that do pop up over time can offer you scope to put your capital into a better performing asset, better performing location, a better opportunity. That's reason number 3. It's a really, really big reason. It also ties into that Sydney Perth analysis that I just did, with Sydney outperforming Perth over a time period being a better opportunity than Perth over that 2009 to 2023 period. That's another reason. So the 3 main reasons are markets grow at different rates, your borrowing capacity is scarce, and selling offers you the opportunity to purchase something else that might be performing better. So there you have it. There's my quick little take, my 3 key points as to why selling makes sense. I've done this many, many times, nearly a dozen times now I've sold. Each time I've sold, I've been able to use myself selling to buy something else. The considerations I take when I'm thinking about selling, and I think it's worth thinking about on your side as well. Now, you need to factor in the obvious downsides as well, which is the transaction costs in property. Stamp duty is expensive, selling costs expensive, staging a property could be expensive. There's a plus minus 10% cost, in buying a new asset, selling your asset, and realizing that. And on top of that, you have a sort of unrealized tax obligation that you'll have, that you will realize, and that you will have to pay when you do sell. Those are obvious factors that you need to factor in, but it's just having it in the back of your mind as to, if my asset's not one that's going to be growing over the period ahead, should you be asking yourself whether it makes sense to sell and put your money in a different capital? So that's a question that a lot of Sydney investors have on their lips at the moment, and I think it's worth actually thinking about and considering. And really paying attention to, and looking at that chart of Sydney and Perth and showing you that capital cities grow at different rates and have different periods between, high growth rates and low growth rates, and factoring how much of a return difference you can make by simply reallocating your capital every so often. That is what I want to show you and give you a little insight as to why it may make sense selling. If you enjoyed this video, enjoyed these little anecdotes, enjoyed this story, hit that subscribe button, follow me. It would be absolutely wonderful to keep producing this content for you, share more stories. I'll see you in the next episode.